Thank you very much for joining in today. Good morning, good evening, and good afternoon to all of you. I'm Giuseppe Basile. I'll be your host for this workshop. And actually, before starting, I want to thank Adinda and Vicky for making this webinar possible. Before I start, can you all hear me? Please give me a Y if you can hear me. Okay. Seems pretty okay. Very good. So I want to thank you, Adinda and Vicky, and I want to thank FX Street for making this possible. So today I'm going to talk about a new philosophy for trading success in modern markets. And you might ask, why do we need a new philosophy? Well, let me give you at least 3 reasons for this. There are more reasons. I'll give you the 3 more important reasons. First of all, trading actually became very accessible in the last 10 years, maybe 15 years, surely since 1999, 2000s. So it's very easy to open an account, to fund it. You can even do that with a credit card these days. And also the information related to trading has increased. The number of websites or the number of the amount of information on the internet has increased. But despite that, the number of successful retail traders has stayed the same. So we know today the statistics are very clear. 92 to 95% of retail traders lose money in the markets. And why is that? So clearly there is something fundamentally wrong in the way technical analysis or trading generally is learned and is taught maybe. So that would be one reason why we need a new philosophy. Also, you have to understand that the markets in the last 20 years have totally changed. There are new participants. There is a lot of automation. I'm going to show you. In some markets, up to 80% of the volume is traded by algorithms. So we need to take, into account this fact in the market, which is a grounded fact. Is proven that there are algorithms, and whether we can use algorithms to create an edge for our trading, and I'll show you that that's possible. I think Dimitri is not actually getting the voice. So Adinda, if you might want to help him, I think he has to probably check his. Then the third reason is that the way technical analysis is currently used, I believe that the majority of people who use technical analysis do not understand what are the fallacies and limitations of technical analysis. After all, applying indicators and applying technical tools to price, it's just a way to produce statistical tables of historical data. And now, when you apply technical analysis, you actually are making and can only make consideration on a statistical basis, of course. But there is no one who's telling you that at a specific price area there is participation of program trading or from algorithms. And also, I believe a lot of people do not understand that by adding rules to their technical tools and technical analysis, they are just fitting the data they have, and so reducing the degrees of freedom. So the system they come out with usually only fits that data. It's not able to explain generally the price in a good way. And actually, it's been written a lot about it. I mean, this application of engineering to price data. And there is a very good author, Robert Pardo. If you have the chance to look at his book, you'll understand better what I mean here. So the name is great author and fund manager read their book, his book. So let's get into this then. This presentation, I'm going to offer this presentation this afternoon to the World Money Show as well. So if you're there, I mean, by no means come. I mean, I'll love to have a chat with you. If you cannot make it, of course, because you're not in Toronto, then the information that you get in this presentation is pretty much the same. So if you post anything about this presentation, about your work, about trading, always remember to add the FX Street hashtags Forex Everywhere and FX Street event. So let me jump into this then. Oops. So as I said, I gave you the reason for why we need a new philosophy here. So a risk disclaimer, always take this into account. Those who follow me know that risk is paramount for me. And when the money is gone, the game is over. So you have to be very, very careful. If you have some money that you have saved or money that you want to put into trading, into the financial markets, make sure you get a good education before, because it's very easy to lose money. And I know from information I got from recently from a broker that 22% of people actually retail traders still do not use stop loss, and as a result they get margin calls, and they basically are wiped out. I mean, they lose 5,000, 6,000, and they could actually leverage the money in a much better way and learn the game. So if you are watching the recording of this presentation, please stop it here and read the disclaimer here. So just 2 minutes about myself. I have a background as a computer engineer, earned the bachelor in 1999, and I worked for a lot of years for a big five, for Accenture, IT, consulting. And at some point, I decided to make a change. That was in 2005, but it took to me 4 years to prepare. Then in 2009, I left the company, took on a master starting in 2008, a master's in finance. And in 2012, I also became certified market technician. My interest in the market started in 2001 and started studying, averaging 20 hours every week. In 2003, I resolved in doing serious research about the market, but only in 2006 I understood that I need really mentors in order to make that leap, to make that change. And I had people like Van Tarp, psychology, risk management, money management, huge. Ivica Juracic, Dear Barton, David Esley, Joe Di Napoli. I have over 17,000 hours exposure to the market, screen time, and 8,000 only collected in the last 3-4 years. I started FibStalking.com in 2012, which is a blog which actually showcase my research and my techniques. And I'm also an International Federation Tech Analyst Associate and researcher, and I had 3 papers published in the last 3 years on the journal. Recently, I've launched FibStalker Trading, and I have a first coaching program currently ongoing. It's giving me great satisfaction. I have some people, I believe, they're following this presentation as well. My trading edge is spotting algorithms on price. I call them footprints. That those are areas where I anticipate participation from program trading, and I have another technique to test that participation. So you joined this presentation because you wanted to get and understand what are the points of my philosophy. So let me lay them down for you. First of all, doing things differently. And actually here a substantial distinction, not just a face value, not just a phase distinction. And why is that needed? For the same reason that I mentioned before. When 95% of retail traders lose money in the market, there is something fundamentally wrong in the way we learn the game. And actually I put myself in, because when I started, I was in the same situation, totally lost, thinking that what I read on the book and what I'm taught about technical analysis the way to go? Well, I mean, it took a few years to discover that that's not the way to go. I discovered at some point a great opportunity, the presence of algorithmic trading on price. And that's something that you can only find on very high volume markets. And that includes all the Forex pairs. It includes some major indexes, not all of them. For example, SP 500 E-mini would work very, very well, but the Nasdaq index won't work. Also, a lot of high volume stocks from Amex, NICE, and Nasdaq as well work very, very, very well, and some other instruments like bonds. Now, I'm very adamant about this. This is very important. We can try to think that traditional technical analysis based methods and tools can help us to get a great edge. The reality is that the reliability of the signals that we get from technical analysis is pretty much random. It's pretty much 50%. And as I mentioned before, that's because we are dealing with statistical historical data when we do it, when we use traditional technical analysis. When I say traditional technical analysis, I mean indicators, I mean everything that you draw on the chart, like moving averages and trend lines and GAN and you name it. Now, on the other hand, I take another approach. I have to have something which is proven, grounded in price behavior. And when I see participation at specific areas which are not explained by technical analysis, then I believe and start thinking that there is something different, and indeed there is. And there are only a few things that I'll show you later on that are true about the market. Those are the things that I use in my trading. A lot of people, a lot of traders also invoke the self-fulfilling prophecy. I believe it's a flawed concept. Let me explain you why. First of all, the level where the self-fulfilling prophecy is invoked are typically known by the institutions with a different name. They're called sitting duck levels, which means that these levels, they're taken advantage consistently by the institutions, by professional traders, and so. By knowing that there are levels there, institutions and algorithms as well know that these are places where they can find volume. But are those levels and indication really responsible for trends? I'll show you a brief example later on, a very, very small example where you can apply that to basically any type of TA tool. MRC is coming in and asking, what did we cover so far in one sentence? I just made an introduction of why we need a new philosophy, and I was going through my 13 points of my philosophy, MRC. You can watch the recording. You didn't lose a lot, but there are some very important concepts, of course. Hope that helps. So avoiding reconciliation of multiple signals. When the more signals we put into our trading platform, the more, and when I say signals, I mean different indicators or draws that we made directly on price, the more we put into the picture, the higher is the need of reconciling multiple signals. And very often it's not we are not told what to do when we have contrasting multiple signals, and that happens a lot. That happens a lot. Also, as I mentioned before, the more indicators you put in, the smaller degree of freedom you have in the overall system, and that basically reduces the capability of your methods to match price data. So. Next point is I don't trade based on planned news, and I don't rely a lot on fundamental analysis. So let me start from news first. This is my belief, and it might be a bold statement, but bear with me. I mean, I've been seeing these things in the last 6 years. Now, algorithms are well position in advance of planned news. And basically what happens is that they use the additional emotional participation and volume to actually take their trades and their position to targets during planned news. So they don't participate during planned news. They already position on the larger time frame, 4 hours, daily, weekly, and that's what they do. I think we see this all the time. I think yesterday we saw this on the US dollar versus the Canadian dollar, and so when it comes to fundamental analysis, I only use that to confirm my technical view on the larger time frame, like weekly and daily. And you can review an article I published on the Japanese economy on fxtrade.com, in which I used the analysis of the Japanese economy and currency to support a technical view. And the market was around US dollars to Japanese yen was around 101.50 and went to 109 in 50 days, which was my first target. So next, I strictly follow key rules, and I push for a correct process of decision making. Key rules first. There are some rules you have to respect all the time. Having a stop all the time. Trying to generate a free risk trade as much as possible. Protect precious capital. Rule number 1. I mean, if you don't protect your capital when the money is gone, the game is over, and you have to start all over again. When it comes to decision making, trading, it's just all about that. We say as traders we are paid for the quality of the decision that we take. So you have to have a process, well-defined and well-thought process in place. A few traders do that. I believe not everybody can do that, but I do my own research on modern markets, and I contribute also to the Federation of Technical Analysts. Risk and money management, you have to view them, and I view them as a way to reach objective. What does that mean? A lot of people, when they start trading, they start with maybe 5,000, 6,000, even 10,000, and they look at trading really like a way to generate income, which is fair. The point is that that's not the way you can maximize your success. To maximize your success, you have to be able to generate steady, small percentages on your account monthly, and then you have to leverage other tools to multiply that consistent result. And those tools are called risk and money management. And particularly there is a concept, OPM, other people's money. You use and leverage the gains you get from the market, as well as when you are consistent, you can leverage any money. You can leverage other people's money. You can actually invest and trade other people's money too. So I think there has to be a mind shift there, and that's what I always recommend to everybody: a mind shift from looking at trading as a job, as contrasted to looking at trading as a way to grow your account. And to grow your account, you don't have to focus on absolute dollars amount. I also have 7 pillars of my trading, which are really an extension of the 3 M's, the methods, mind method, and money to the modern markets. I'll talk about this later. In the markets, there are also truths and principles that have to be respected. For example, to respect risk, to make sure that you only take a trade when you can accept the risk. A lot of people do not accept the risk. A lot of people don't see the equation, the other side of the equation of trading, which is losing money. They don't realize that when they put on a trade, actually they have the potential to lose their full account, especially if they don't control risk. And I had a few people coming to me with a similar problem, to help them being bailed out from a short or from a long position, from a ill-positioned trade. So this is part. What is difficult about this principle and truths. For example, there is one truth that is very, very important, which is the market can do anything. So how do we factor that into our trading? It took years for me to actually have come out with a trading system that would respect all these truths and principles. Very important is also adherence to market psychology. What is this? Well, the way I define market psychology is the aggregate behavior of the average trader taken as a group, and that shows up. And traders, they get involved in places where they shouldn't. Typically, they get involved around first or second targets of algorithms. And so there is always a reaction there because there is at least a profit taking. And if there is a trend change because that sequence of measure move fails, clearly now a lot of people end up holding the bag. Another place where, on the other hand, people do not participate, it's right at those areas where we expect participation from algorithms. They don't participate because it's very difficult to take trades in those spots. And my last point of my philosophy is that I will always gather for retail traders. And the reason for that is it's very easy when you start making money in the market or you become consistent to be lured into managing funds, managing other people's money, which is fine. The point is that we are gathering that way. You only gather for people who already are wealthy, already have means, already have money, and you're just incrementing that. On the other hand, it's very difficult to commit to have retail traders and bring as many as possible those 95% into the elite 5%. So these are my 13 points of my philosophy. Are there any questions in relation to this? Is there anything that leaves you kind of dizzy? It's most of it. It's common sense, really. Of course, there are some innovative points here, and especially how we leverage the presence of algorithmic trading. So let me offer you an example straight away. But before I get there, let me show you the new reality of modern markets and whether there is a better way compared to technical analysis. So as I told you before, the presence of algorithms is overwhelming, and especially in some markets, it goes above 80%. Which markets? The futures markets. So over 80% and growing, could be 85, 90% in 2014. When it comes to options, there is an estimate. I have 2010, 20% of volume moved by algorithms. Forex, which is very important to us, 25% estimated in 2006 and believed to be 45% between 2010 and 2014. So it could possibly be higher. And then there is the monster, the class of high frequency trading, which is estimated on equity to be between 35% to 75% of the European and North American equity markets. So that's huge. Now, the effect of high frequency trading is different from the effect of program trading, which is another class that is said to be responsible between 20 and 30%. And this class is quite important because it's not like high frequency trading that acts very quickly and with a big turnaround. This class acts very slowly on daily and weekly time frame, and I believe it's responsible for trading, for trends, and keeping the trends active. And you have sources here. So my question for you is: are you still sure you want to keep using only traditional methods and tools, knowing that modern markets are totally different? So what we know for sure in the markets, and I am reconnecting here to that point of my philosophy, which is I only use proved and grounded concept in my trading. So what is really true about the market? Only a few things are true. One of these is existence of trend, and we know that visually as well. We don't need a big confirmation for this. Now, I'm not going to define what is a trend, that it's higher highs and higher lows for uptrend, and the opposite for downtrend. And this is a concept that was introduced by Daddy, our granddaddy Dow Jones back in in the 1900s. So, and a little bit before actually. So this aspect of the markets can be proven formally, and here is the research if you're interested. But another thing that is true about the market, other things that are true about the market are related to algorithms. And we know that there are algorithms and HFT trading in the markets, and I show you the figures as well. And I have also a proof, a observable proof that these algos impact setups and participate at relative swing and low highs, and are able to define and maintain trends in modern markets in certain conditions, when there are no news, no planet news, when there is no intervention from the central bank, when there are no geopolitical huge events. And in those conditions, algos are stopped, and then they easily and quickly readjust to the situation in a few hours or a few days. So they still make an impact also when there are these huge events. So let me show you an example now very, very quickly. And also in this example, I'll show you also why, and this is only an example, but why self-fulfilling prophecy are not responsible. Self-fulfilling prophecies on technical analysis are not responsible for durable and big participation in the market. So what you see on the screen is the 4-hour chart of the euro dollar. And I have a number of levels and areas mentioned here. Now, the way I look and model algorithms is through a special use of Fibonacci. I'm not going to go down to details here. There is a nice webinar I gave back, I believe, in March. It's one of the first webinars in which I spoke about the Fibonacci. It's a critique of Fibonacci and how actually what are the Fibonacci number are used. So in this case, when we trace from, let me see if I can annotate this. Well, unfortunately I cannot. Yeah, probably I can. So I trace from the low in A to the high in B, and we get this participation here, the 50%. And I also have 1 and 2 targets here. The market gets into D and then into E, and then continues higher, and we know now that this market is extended, and we use another technique to identify this F. I trace from B to X. So as you can see, it's a very different way of using Fibonacci. Now the market gets into the first target of this new trace, but never makes it into the second target, but ends up at Y. And then there is this nice bounce from the 20-day moving average. I don't use, as I mentioned before, I use no indicators. I'll show you later on my charts. I have no indicators in them. So here we have a reaction and the sitting duck level here, whereas there is a reaction on top of this 20-day moving average. But see, the market had to come anyway into the next area of support before a sensible move could happen. Can you see this? These levels are actually fake. So what happened here is that when the market got into the 20-day moving average, there was of course participation there, but the market actually went higher and then had to retrace into the next area where participation from program trading is expected. So this is a simple example, and I can show you plenty of this on trend lines, on the use of bands, you name it, and you will see these kind of things all the time. You'll see that the signals is too early or too late, but it never coincides, or very, very rarely coincides with the area where there is participation from program trading. So let me show you a most recent example here on the euro versus the Canadian dollar. And here the situation is the same. Let me see if I can annotate. If I can, I'll do that. Otherwise, I'll explain this. So I'll explain this chart. This is the daily chart of the euro Canadian dollar. It's a recent price starting from March here. A is in March. When I trace from A to B, I get C, and this is an entry point in the trend. Now, I don't usually trade this level blindly. I always use a technique which I call FibStalking technique. It's a way to procedurally test these areas. In this case, this is an area of resistance. The price went down into first and second target. Again, I cannot annotate here. First and second target D and E, and actually went lower into F. And then again, when I trace from B to F, I get this G point here. Again, another good area to get short in the markets here. And I went into H and I, and then just below that. Now notice how nicely when the market gets into this targets here, there is always a reaction that is profit taking. We are seeing it here. And then, of course, we see a lot it here. Now, when the market gets and breaks the next setup, that's a violation of the whole sequence down here, and that's the reason why we are seeing this market moving higher. And I gave, if you subscribe my newsletter, you'll get for free my weekly and midweek review, and that's where I give some of these values, some of these levels as well. Hope that's interesting. Have you got any questions about this? I hope you're still there. Are you there? Give me a yes if you're still there. Very good. Very good. Thank you, Victoria. Thank you, Pantelis. Very good. Bob, okay. So let me continue then. Thank you, Victoria. Let me continue then. So I'm showing you that there is something in the market that generates this participation here. And mind that once you have half and you start tracing this level, you know this level well in advance. You will know this level with 2 weeks in advance here. Can you see that? F to G. This is a daily chart. So more than 2 weeks in advance. And then if and when the price gets into this area, you can apply the FibStalking technique, which is my procedural technique to test these levels. Because of course the market can do anything, right? We saw that that's one of the tenets in the market. So the market could also continue higher. You don't know that. So you need a way that tells you that the participation on the downside is stronger than the participation on the upside. And you can do that with some techniques. So let's continue here. So in X, here we have a violation of the trend, and we have the start of the move higher. So my 11 ways of doing things differently. I explained before how important it is to do things differently. And the reason is that not just face value. The reason is that we need to do things differently if you want to change the average result. Now, I joke sometimes. I tell traders in a similarly blunt way. I tell them statistically, you are all losers, and of course you are not. But we know that 95% of people lose money in the market. So you might statistically be in that group. So of course you want, because you have now watched this presentation. So joking aside, let me go and show you the 11 ways I do things differently. First of all, become fanatic about it. Now, there is nothing good in being fanatic and in fanatism, but what I mean here, it's really be convinced that you have to resolve to do something different if you want to be successful in this game. Otherwise, just live today. Don't risk your money. Don't do this, please. Don't do it. So as a result, we need a new mental framework to play the game to win. What does that mean? That reconnects to what I told you before, not looking at trading as a way to generate income right away. Unfortunately, there will be some background noise because they're working on the facade of my building. Sorry for that. I hope that does not disturb you, but let's go back to play the game to win. How do we play the game to win? We don't look at it as an income generator, but we look at it as how much I can consistently do in terms of percentage points on my money monthly, and then we leverage it. So this is a game you win in defense, and playing defense does not allow only to avoid losses. It also allows to win, and a lot. So what does it mean? What does that mean, planning defense? Is to have a fixed risk, 1%, even that if that fixed risk does not produce a huge dollar amount to you every month. Because, see, you have to see this as a process. You start small, you start making 2%, 3%, 5% monthly, and then you leverage from that. And then, and it's not the opposite. Some people, I had a chat with a girl 3 months ago. It was very funny because, she knew the value in learning to trade. She understood that this can be an evergreen skill for you to learn that can serve you well for your life. But the point is that she had not a very good start. Actually, she had 5,000 and she lost 4,000. And then she came to me and asked, Giuseppe, do you think that it's possible to make 4,000 out of my account? And I said, well, I mean, of course it's possible if you're patient and your account is well sized. So what's the amount you have in the account? Well, I only have 1,000. So this lady it was very funny actually. We had a joke on this later on. She understood it, but basically, this making 400% in a month. I mean, do you want to set yourself for failure? That's the way to go. So there are other ways to do that. Of course, you have to follow the rules of the money game, and this includes actually this actually includes so moving so doing sorry for that, doing not looking at market in absolute numbers, but in terms of percentage. There are some other rules that you have to follow. I have a question here from Mohammed. 95% loser means the market moves. The market movers ruling the market. Well, no, I mean, it means that you don't have control on the market, and you have to take your you have to position yourself in a way that if the market does not go in your direction, then you don't lose money, or you just cause a break even. This is called free trade. I'll talk about this later on. In a way, I believe there are some algorithms that have a big effect on the market. So you can call them market movers. Yes, I do. And it doesn't really matter whether they are there or not. What it matters, Dimitri, is actually that we observe this participation at those levels. Okay. Now, when you start looking at trading in a different way, that you have to play to win, you have to play in defense, and you start using the rules of the money game and understand that, you can remove pressure from performance. Now you know that you don't have to make 400% or 100% in a month. You know that doing 5% or 3% is more than enough. Why? Because there are ways to leverage. There are ways to leverage the market, that leverage your gains using other people's money, using money management techniques. Okay, so also a lot of people come to me and ask, give me the method, and I tell them that's information. But to be successful in the market, you have to have information, trust. You have to put in place a process that will lead you to take the trades always the same way, and you have to mind execution. You have to make sure that you execute all the time the same way. See, algorithms in a way control the market, and they follow cause and effect. They are mechanical in what they do, and you have to learn to be mechanical as well. And there are spots, I can tell you, it's very difficult to buy or sell if you don't have a strong reason for doing that. It's very easy for algorithms, very difficult for you. So execution is very, very important. Now, I also believe that you can condition yourself. Our mind was built to receive comments and accept comments. So why don't you use that feature and actually program yourself, doing some self-predictive programming. And in my coaching program, I also have these kind of exercises. That's the way you condition yourself, and you pre-program yourself to look at the market and act on the market consistently and in a way that is consistent with the market. As already said before, I refuse to apply traditional technical analysis. And the reason for that is once you realize how different these markets are these days, the modern markets, and also the participation at certain areas that is not explained by sitting duck levels. I will not call them self-fulfilling prophecies levels anymore. You realize that you cannot blindly accept what is offered. Psychology, of course, is king. I distinguish in two types of psychology: the trader psychology and the market psychology. The trader psychology is, of course, the way we respond to the market, and of course is very, very important. If we bring our everyday psychology into the market, even if you're very successful in life, you might not be in trading, and that would happen to me at the very beginning. Now, I don't know if Muhammad wanted to add something. Major banks and financial institutions. Yes, I mean, these are the big institutions who are able to run the algorithms and have billions invested and traded with them. So, of course, nobody's gonna tell you this because because it's an edge that can be exploited. Leverage the presence of algorithms in modern markets. Of course, once we know that there are algorithms, can we leverage them? I showed you a few examples. I'm going to show you some other examples. And price discovery, that's a very good feature. Very few method or system that I know have this feature. That's a way to forecast or identify high probability scenarios on price based on certain levels that are violated, and that's something that it's very, very interesting and actually allows you to take counter trend trades and trades that normally are very difficult to take. So these are my 11 ways of doing things differently. Have you got any questions so far? I'll give you just a few seconds to write down your thoughts and things that come to your mind. So Dimitri is asking how we can make algorithms that compete with banks. Actually, we don't compete at the level of the high frequency trading, for example. There's no way we can compete there. We can only compete at the level of algorithms that act on daily and weekly time frame, because we have plenty of time to go. Unfortunately, time goes by very, very quickly, and I wanted to show you some other examples here, but what I'll say is that we can use this on 15 minutes as well. I have my 7 pillars of successful trading, but you can look on my blog as well and look for and search for pillars, trading pillars. And unfortunately, we only have 3 minutes to go. So of course, this works on the bigger time frames as well, and there's a technique that I call FibStalking technique that allows to basically test these areas. In this case, we have A, B, C, and we have this move that is highlighted here into this level. We can actually time that, and we use the same approach. And when there is a violation, basically that's a confirmation, and it means that there is pressure on the upside in the market. And if you look at the previous slide, you see that this pressure that came from C here actually pushed price all the way into the first target D, where there was a reaction. And this technique I call FibStalking timing technique. It's a proprietary technique to test the market. I will just go very quickly through these points so you have them in the presentation, and I might speak about those in another presentation. So I wanted to have a Q&A, but unfortunately there is no time, and Adinda is asking me to wrap up. So if you want to get more information, just come to my website here, fibstalker.com. You can drop me an email. I respond to the emails personally all the time. And you can also subscribe to the free newsletter here If you don't have time to write it down, you'll get it in the recording. So feel free to write me. And I also have a coaching program. There is a second session starting in December. That's it for today. Thanks a lot for your participation, and I'll see you. I'll see you next time. Thank you very much. Bye bye now.